Yes, I got a great webinar called Become Part of the 9% and on 91% lose in spread betting. And you've got to, well, there are so many things you would need to do to become part of the 9%. If it were that easy, everyone would be part of it. And there's a lot of intelligent people making up part of the 91%. And in fact, you will always vacillate. You'll be in the top one, and occasionally you'll be outside the 9%. But what you do need to do is you need to potentially decide on a strategy that looks after all elements of money management. And we've discussed the risk reward, we've discussed losses. You've got to manage losses, that keeps you in the game. You've got to believe you have a system that will make more than it gives back on its winning. It will win and will lose all the time. No one is ever going to have 100%. So accept that losses are part of the game and manage that. Become as systemic as possible in determining what your setup is. So the more it can be reduced to logic, the better, and the tighter. And then you need to stick to the system as systemically as possible as well, which most people are incapable of with emotions, particularly after, say, 3 losses. You'll be snakebite fearful, and after 3 wins, you'll be piling on twice the size. And that'll be the one that'll lose and give back all of those 3 wins and some. So that's where focusing on, if you had to develop a black box system, is not a bad process for defining your strategy and that which you find interesting. Observing charts, a lot of observation, a lot of drawing of charts, and a lot of use of patterns. Patterns are probably the most powerful technical analysis tool for me, outside of the larger trend Dow theory.
What are some trading mistakes to avoid?
Most trading mistakes made by beginners, even intermediates, and occasionally even advanced people when they lose their heads, is to do with trade sizing. So they take a loss too big. There's no damage done in taking your managed loss. That's part of the game and being wrong. The problem is that recovery ladder, when you then emotionally negatively respond to taking an already slightly bigger loss. So let's say you lose 15 or 20%, and then you think, damn, I want to get back to where I was, so I need to make 25%, so I'll trade bigger again, I'm sure I'm right this time. You can't cope with the mental, it's like a mental cognizance dissonance, cognitive dissonance that makes you need to get back to where you once were, because you're now seeing yourself as the lesser self as dictated by this balance. And that then pressurizes you into trading bigger again on what looks like a sure thing. But now you're punch drunk because you must find an opportunity quickly, and it's not a sure thing. It's the first thing you grabbed hold of that best represents a possible trade. So you then bastardizing your criteria to grab hold of something that you expect to leverage you back into where you once were. This is a very big fatal spiral, because once again you then overtrade because you've got to make back more to get back up, and that's the recovery ladder concept, and boom, that is probably the single most destructive, that sees someone have a £10,000 account reduced to, you know, a few hundred or £1,000, and then virtually giving up, realizing that they've blown it. Size.
It's 91% of people are in that sort of category.
I wouldn't say 91% are in that category. They don't all blow their accounts up from £10,000 down to 9, but they aren't possibly consistent with money management as a whole. And sizing is one element of money management. Don't forget, I said risk reward should be central to that as well. So they're taking trades that aren't worth the squeeze. The juice isn't worth the squeeze, and the probability of win rates. They haven't tested what likelihood they have of winning. Too tight a stop, something else I've mentioned. All of those things all fall under the larger money management cluster, and those are all key.
So do you agree with this statement? The only way to make money is slowly and steadily over time, not trading forex indices, commodities, etc., because they're a giant casino.
No, I wouldn't agree with that statement at all. Those underlying markets can be traded profitably on a consistent basis. There isn't an efficient market hypothesis that truly keeps everything at true value. Anything that involves people will have reactions and overreactions and underreactions. So no, I think you can. I think I wouldn't be in the game if I didn't feel that there was an edge that could be taken.
most private traders doomed to lose?
Yes, I'm afraid so. As I said, I've heard, I've never checked this out myself, but which is quite scary, the average the average spread betting or contract for difference account client lasts 3 months. It takes 3 months for him to wipe out his funds. I don't know what the average deposit size is, but yes, most times I'd think your average person is always going to lose, particularly if he's dabbling in foreign exchange where the margin granted to the client, i.e. the leverage is so huge that the chances of being wiped out are very, very high for anybody.
Well, what do you think are the most common errors that young, new, inexperienced traders?
Overconfidence, improper use of leverage, i.e. betting too big on limited resources, inexperience, in some cases stupidity, but not all these people are stupid. Impression, trusting people. I mean, I find it's as an investment guide, and this sounds very cynical, but so be it, that is never to believe anything that anybody tells you. Assume that any director of any company talking to you or broker is lying to you. And unless they prove otherwise, assume that everything they say is false. And that it does sound a bit negative, that, but it stands in good stead because more often than not, particularly on smaller companies, you're up against these guys are promoters. That's what they do for a living. They're you know, snake oil salesmen. They're charming. They'll say anything you want to hear, and that's a lot of the reason private clients lose money is because they believe what they're told by people who should know better, and they don't realise that they're being ripped off. People naturally are optimistic. They want to believe the dream. And a lot of share promoters are some of the most charming and persuasive people around. That's why I don't like meeting them.
Yeah.
Well, that sounds maybe a bit cynical, but just assume that when somebody's trying to sell you something, they're not doing it out of charity. When your broker wings up and says, you ought to have some of these, or when you go to a exhibition, say, if you're a private investor and you go to one of those money conferences, and every little company's got their stand with a smooth-talking chief executive in a suit, you know, offering you a glass of champagne and explaining to you in great detail how wonderful his company is. Just assume that they're bullshitting you, because they are 9 times out of 10, unless they prove you pleasantly surprised, which, like I was saying, reading, when they say, oh, I'll make a note of that company. God, they actually did what they said they were going to do. But most of it, particularly on the smaller companies, most of these people they just want your money so that they can live comfortable lifestyles. As shareholders, you proudly think you're owning the company. You're not. You're just paying, more often than not, you're just paying for these guys to pay themselves 100, 200,000 quid a year for doing nothing. And then when they run out of your money, they come back to you and ask you for more. So they have to be persuasive, these guys.
Yeah. Why do people buy shares whose numbers show them to be expensive or poor quality? Do you think?
Very good question. Because they're stupid. I don't know. Because their brokers have told them to. Because people buy shares for a number of all sorts of reasons. And because of the wealth of information we get on the internet now, everybody can be an expert, and a lot of people think they are experts. And a lot of people, for instance, make very fundamental mistakes. Like they might think, cool, that's a very nice product, I'll go and buy the company that makes it. And without sort of thinking, you know, is the share price pricing in that it's a very nice product? Or, cool, I don't like that, I'll short the company because I don't like their product. I mean, people are very unsophisticated. And give them, you know, a trading tool and an ability to check share prices 24/7. They start to believe that they know what they're doing, and a lot of it's momentum. And you know, a lot of people make money. They might buy a couple of stocks just because they're going up and do well out of it. So it's something that they continue to do until it goes wrong, which it normally always does.
What do you think you need to give up in order to become a successful trader?
What do you need to give up? You need to give up being emotional. Give up allowing things to get personal, which is very easy particularly if a position is going against you. It's very easy to get sort of angry and emotional, and that never helps. You've always got to take nothing personally. Give up being, falling in love with the stock, or the opposite, falling in hate with the stock, as it were. Always have an open mind, and always be prepared to change your opinion if you're wrong. I mean, for instance, if you want to short a stock or go long of a stock, for instance, if say you want to short a stock, you don't want to go and read why other people think it's a bad idea. You think it's a bad idea. You want to read why people think it's a good idea. You know, what is the case for buying this? You want to read the analyst buy notes. You don't want to sort of, which is the human thing, is just to stick with all the sell notes and say, oh yeah, I agree with that, and then feel sort of bolstered by it. You want to go out there and find out what the opposition are saying, and the particularly quality opposition. You know, if there's an analyst you respect, for instance. I'm not talking about a company taking a stake like I've just mentioned, but you know, if you think that you know about a company, then find out who the expert on it is, and if they have a differing view, then take note. Don't take comfort from other people sharing your view.
We're told you're also a follower of horse betting, so much so that many UK bookies now refuse to take your money. But what are your usual stakes?
Well, I think that needs to be qualified, that remark. It is true that I have had accounts which I have operated closed in the past at the request of the bookmaker in the light of the results. But bookmakers really are fair weather friends often enough, and if you lose money to them, and I've lost a great deal of money to 3 firms in particular these last few years, I can assure you they're very happy to keep the accounts opened. I won't, since this is a family broadcast, I won't tell you how much I've lost, but believe you me, it's a lot.
Why do you love horses?
I don't love horses.
Why do you love the thrill of betting on horses?
Well, it's the adrenaline rush, isn't it? That's why people gamble, and I have the additional incentive, if I can put it that way, which is that having formed an opinion, however foolishly, I like to bet that I'm right. But I mean, there are all sorts of other fools who've taken that view in life, and nothing new about that.
What about gambling and share tipping as one and the same?
Well, of course they're the same. They are forming a view and betting on it. There's no difference.
Right.
I don't know why, incidentally, a lot of people think investment is different from betting on horses, and my view is that such a view is insane. There is no distinction between the two. A horse race might be over in 2 minutes, and a share to come to fruition might take 10 years. But the idea is the same, to profit by one's judgment.
What are the essential skills required for succeeding as in either field, really?
Well, one must have good information. That you must have. With horse racing, it's absolutely vital one has good information. As I think I just told you, in recent years I haven't had it. But on the matter of shares, of course, there is the problem of law, which came to, I wouldn't say fruition, it came to a halt as regards development with the Criminal Justice Act of 1994. I myself think the law is fundamentally flawed in that it seems to me entirely legitimate for companies to brief the market as to how things are going, whereas the law, as understood in practice, is that there's a duty to the public as a whole. Well, I think that's a foolish and uneconomic idea, but I can tell you it's very much in the ascendancy, and if you ignore it, you can get yourself into a lot of trouble.